has moved up from the time that we started speaking with Mr. Lal there. Well, in its first results post-listing, Delhivery has broken even on the EBITDA front, while the reported net loss has remained the same, even as top line has doubled, revenues have doubled. Sahil Barua is Managing Director and CEO at Delhivery. Is joining us right now to take some questions. Sahil, great to have you with us here. And might I say congratulations, Prashant this side. You know, you're a proxy for sort of e-com in India in a way, because that's the segment that you're most dependent on, and you've registered pretty strong growth as far as the express parcel business is concerned. Could you explain what happened in the quarter and how is it set up, over the next, say, 6 months or so? What should we expect?
Sure, thanks for having me, Prashant. While we're a proxy for e-com, I should point out that all of our business lines actually have grown pretty strongly if you look at our numbers for Q3 and Q4. In our case, what you're seeing is both secular market growth, so e-commerce market has grown somewhere between 35 and 40%, but also a shift towards delivery. In general, we've gained a lot of share in the last financial year. I think as we've passed operational efficiencies back to several of our customers, our share of wallet with many customers has grown. Outside of which, the other big driver of growth for delivery has been the part truckload freight business, which is now approximately a quarter of our revenue. So 24% of our revenues in Q4 came from the PTL business, where we acquired Spot On and have been integrating that business with the larger delivery network. So it's been both growth with the market as well as gaining share in e-commerce and PTL.
Sahil, hi, good morning. I know it may be very difficult to predict, especially for a business like yours, but any clue on when the company may turn positive, both on a free cash basis as well as on a net basis?
Sure, you're right. It is a little difficult for us to predict given the market's been somewhat volatile. I think the way we look at the business is we've broken even at an EBITDA level, which is operating profits. We continue to invest in building capacity. And so if you look at our non-cash expenditures, depreciation and amortization have grown. We typically spend close to about 6% of revenue on CapEx. We expect that to decline to close to about 5% over the next year or so. Our estimate is that adjusted EBITDA profitability will continue, and it should take us somewhere between 6 to 8 quarters, hopefully, for us to turn free cash flow positive.
So you're saying 6 to 8 quarters to turn free cash flow positive, but on a net basis, you think the losses would continue, especially through the course of FY23?
I think we'll have to project forward. Operating profits will continue, adjusted EBITDA. In our case, once you take out all of the one-time adjustments that we've made in fiscal 22, actually, I think we're pretty close to break even at a PAT level. So hopefully, in the next financial year or at worst, the financial year post that, we should see profits at a PAT level as well.
Sahil, so you said 24% of your revenues came from part truckload, right? And,
that's right.
Express parcel was how much in Q4?
58% of our revenue.
58%. It's a pretty fundamental question. I'm sure you heard from investors as well. What stops large e-commerce companies from handling their own logistics? They actually already do. Why wouldn't they ramp it up big time? Amazon, Flipkart, and why would they depend on an outside party? Yeah, go on.
So fundamentally, the way we look at the market is, let's say Amazon and Flipkart, who are the two large marketplaces which have their own self-logistics, form even close to 60% of the market going forward. Typically, they will end up outsourcing anywhere between, like for us, with us today, anywhere between 10 to 15% of their logistics requirements, which is more because they cannot capacitate for their peak requirements, and this market is still volatile. In the remaining 40% of the market, which is made up of smaller marketplaces, vertical leaders, the long tail of e-commerce, direct-to-consumer brands, or omni-channel brands which are going online, delivery share of wallet will typically be anywhere from 40% all the way to 80% or 100%. And so when you look at our market share, if we have, let's say, 40 to 50% or 40% of the market, that itself is nearly 16 to 20% of overall parcel shipping, plus what we will get from the marketplaces. So we're not really dependent on any single customer. We're not really dependent on the large marketplaces. Our business is quite diversified. And so it doesn't really matter to us what the outsourcing strategy for the large marketplaces is.
On the part truckload business, Sahil, what's the outlook? looking like? I mean, that's a large unorganized market, but very large in size. How do you see that evolving for you?
Fundamentally, more or less the same way as the express market. When you think about it, part truckload is really just express market with significantly larger package sizes. It is a business of consolidation and deconsolidation of freight. The objective that we have is to build large amounts of high quality capacity to carry part truckload freight, something that historically, Indian players have been relatively slow to do. There are two big movements. One of the big movements in the market is away from traditionally slow part truckload freight to express part truckload freight. And post GST, we've seen that big shift. And the second is away from unorganized players towards organized players who are able to provide greater visibility and a large number of value-added services. And so, we expect that this $10 billion market will very, very quickly become consolidated. Similar, for example, if you look at the US, the top 5 players will form maybe about 60% of the PTL market, whereas the top 5 players in India today form less than 10% of the PTL market. And that's the big opportunity for delivery.
Okay. The last time when we had spoken, I remember you telling us that you have the lowest cost model in the world for the kind of deliveries, kind of parcels that you deliver. You have the most cheapest and reliable parcel delivery service, right? What makes you stand out from the others? I mean, how are you managing to bring down your costs? And any way that you can increase cost efficiencies in FY23, or is this it?
Yeah, absolutely. Fundamentally, logistics is not a very hard business. It's essentially about creating productivity of 3 kinds of assets. One of them is people, the second is real estate, and the third is fleet. What allows us to create efficiencies is the manner in which we orchestrate our network, our engineering capabilities, and our technology. With the data science and technology capabilities that we have, we're able to route trucks much better. We also use larger trucks than traditional players are able to use. And we use a blended network, which allows us to merge efficiencies between our part truckload business and our express business. And all of this, I repeat, is driven by the fact that we orchestrate our network in real time, whereas traditional logistics players have made decisions on how to run utilization, once a year or once a quarter. We are optimizing our trucks and our routes in real time. We're figuring out what the most optimal load combinations and the most optimal route combinations are for them. That's what allows us to drive efficiency. And we expect this to continue.
Sahil, what is the expectation of average realization per shipment? And how do you see that evolving? Because there is pressure, there is competition, others want to get a piece of the market, like in all industries, but it's also a lucrative industry, it's unorganized, right? As you've basically shown, within a decade, you are where you are. So what's the expectation and realizations from here?
So if you look at our own numbers, I think we've brought realization down to about 72 rupees a pack in our express business over the last 3 years. Our basic approach will be that as we continue to gain cost efficiencies, we will continue to pass these benefits on to our customers. The logic is very simple. The more our customers save on logistics, the more they can invest in their businesses and grow. And ultimately, that's how we make money as well. So we expect that we will continue to some extent as we gain efficiencies to pass these benefits on to customers going forward.
Okay. Any other way that you're trying to combat the rising competition in the e-commerce space? I mean, e-commerce is growing for you, but then it's growing for everyone else as well, right? And I'm sure there'll be a lot of competition in the months to come. Any other way to combat that?
No, I think fundamentally we have to grow larger. We have to continue to invest in capacity, and we have to continue to be the most efficient player in the space. While it is a competitive market, at the end of the day, last year, the market grew somewhere between 35 and 40%, and delivery grew 100%. So I think in that sense, our competitive position is quite clear. We've gained a lot of share in the last year. And I think as long as we continue to execute strongly, we will continue to have our fair market share in some.
In the beginning, you said that you expect capex, what you spend on capex, to drop from 6% to 5% of sales. Where will that money go into? Will it go into which business, basically? Will it be part truckload? Will it be express delivery, the e-com side? I mean, how do you see total capital employed pan out in terms of business segments over the year?
So it's a combination of our transportation and our warehousing business. About 60% of the capex that we will spend will come from our transportation businesses. In our case, we don't separate the capex between e-commerce and freight because they share the same network, as I mentioned, which is something that's unique about delivery. So this capex will go into building automated sortation centers. This will go into building larger trucking terminals. So we've built 3 large mega facilities which are a first of their kind. Our facility in Gurgaon, for example, is the first fully automated freight handling facility, and it handles both freight and e-commerce. So we will continue to expand from 3 to close to about 7 semi-automated trucking terminals and building out our ASC capacity.
All right, Sahil, pleasure speaking with you. All the best for the year to come, and congratulations on these numbers. Well, that is the word coming in from Delhivery. They do say that they will take about 6 to 8 quarters to turn free cash flow positive, but they're optimistic that they will be profitable at a net profit level by the end of FY23 or FY24. So that's the kind of timeline that they're giving. By the way, let's move on. Nimesh is here with us with the standout brokerage report. So usually we address these reports before market opens, but today there's an exception. Nimesh, why is that?
Well, we missed out because of the MSCI link that I was doing. But anyways, the today's standout report is on Indian auto suppliers. Interesting report from Credit Suisse. They've initiated coverage on 3 stocks, and they find value in this current macro environment. The 3 stocks are Motherson Sumi, outperform rating, and that's the top pick for Credit Suisse with a target price of 166. The second stock is Bharat Forge, again an outperform rating with a target price of 903. And the third stock is Sona BLW with a neutral rating and a target price of 552. Now, why Credit Suisse is bullish on these 3 companies is because they believe that the Indian auto suppliers are gaining global market share, and not only that, they're also benefiting from PLI scheme as well as strong domestic growth. So that's the key reason for them being bullish. Now, as far as the 3 stocks are concerned, the biggest gain according to Credit Suisse will come in Motherson Sumi, largely because large amount of the large quantum of the order book was marked down because of the slowdown, and there they see the biggest upside. So that's the first stock, that is Motherson Sumi. Even for Bharat Forge, Credit Suisse believes that the recovery is underappreciated by the market at this point in time. So that's the second overweight position there. And on Sona BLW, while they're bullish on the growth, but they believe it's all priced in. So 3 stocks where they've initiated coverage, 2 outperform, which is Motherson Sumi and Bharat Forge, and a neutral rating on Sona BLW.
Nimesh, thanks a lot for that. Stocks doing well today, of course, the ones that Nimesh mentioned in the market. The mid-cap index, by the way, is now in the green, and advanced decline has once again moved comfortably in favor of the advances. So just keep an eye. Even the Nifty's cut its losses. We'll take a break. We'll come back and connect with Mitesh Thakkar once again for some fresh technical trades.